continuing on with our topic of non-current assets, remember this is a big topic, it always gets examined. One of the final bits that we're going to have a look at with tangible non-current assets is accounting for revaluations. Now, when we talk about revaluations, this is subsequent accounting treatment. So after you've initially recognised the asset at cost, during the asset's life, you may choose to adopt a policy of revaluing that asset. Okay, so this is at some point during the asset's life that this happens. Now, when a non-current asset is originally purchased, usually the cost is what we used at the initial recognition, which we saw in earlier chapters. Now, when we think about that original cost, that cost is going to be sat in our accounts for several years. Remember, that cost account doesn't really change, does it? Now, if you purchase, let's say, a building, so let's say a factory, 7 years ago, and you purchased it for, I don't know, $3,000, so you got it at a bargain price, chances are that actually, rather than it depreciating in value, the market price, if you were to sell it today, would obviously be quite a bit different. A lot of the time that would be higher than the original cost. So maybe you could sell that factory for $30,000 today if you were to sell it on the market. Now obviously you're not going to sell that property, because if you did, then obviously it would be a disposal that we saw in the previous session. But we're leaving it in at its original depreciated historic cost at $3,000 less depreciation, yet in real life, if you were to sell it today, you could sell it for $30,000. Its market value is substantially or materially different to the original cost less its accumulated depreciation. Now, because of that, IAS 16, the standard on tangible non-current assets, says, well, if we want to give a more relevant and up-to-date view of the accounts for our users, so shareholders, etc., surely it would be better to give a better, more accurate current value of that non-current asset, so the market price, rather than its original depreciated historic cost. IAS 16 says, well, it's up to you whether you want to incorporate that valuation. You can either leave it in at its depreciated historic cost, like we've seen in the earlier recordings, or you can choose to revalue all of your buildings to their current fair value, which usually is indicative of their market value. Think about it. If you leave your assets in at their depreciated historic cost, it's going to give you more reliable information. Reliable because you can verify the invoice price or the purchase price of the cost of that asset. Whereas if you revalue your assets and take them up to their revalued amount, their market value, then it's going to give more relevant information. It's more up to date, it's more current. Now, the IAS 16 standard gives you that choice. Do you go for more relevant or more reliable? Okay, this is where we have a bit of a toss-up, I suppose, between those two characteristics. But it's up to you to decide on what policy you want to choose. So as the management of a business, do you leave it in at its historic cost or do you revalue? Well, if you do choose to revalue, great. The standard allows it. You can increase your asset values up to their current value, their fair value. However, there has to be some rules that are to be complied with if you're going to choose that policy of revaluation. So, moving on then, this choice of policy. If you choose to revalue your asset, well, if you choose to revalue your asset, you have to revalue all of your assets within the same class. Okay? So all of the same category of assets must be revalued. So you can't just say, building A has increased in value by $27,000, I'll revalue that. but actually building B has actually gone down in value, so I'm not going to revalue that. No. If you revalue one building, you revalue all of your buildings. It's to avoid this idea of cherry picking. You know, picking the ones that you like that will give you more favourable results in your financial statements, and ignoring all the items that maybe won't give you a such favourable position in your financial statements. So, if you revalue one type of asset in a category, you have to revalue them all. So all of your buildings, not just the ones that you want to revalue to make everything look good. Okay, so it's to avoid that cherry picking. Revaluations must be regular. Now, the standard doesn't say how often that is. It really depends. Okay, it depends on the business. It depends on where you're getting those values from as an estimate of the fair value of that asset. You know, it depends on the market. You know, with the property market in the UK, for example, the property prices have been declining quite a lot recently. So maybe the management of a company would look at the fair value of its assets more often now because of the way the market is than maybe 2 or 3 years ago. Okay, so although it doesn't say how often, we'd say, I don't know, every couple of years, even once a year at the year end, just to make sure. Any subsequent depreciation on that asset will be based on the revalued amounts. So taking my first example, if you've got a building which you've been depreciating based on its cost of $3,000 and you're going to revalue it up to its current market value of $30,000, well, you still have to depreciate that asset as per IAS 16, but you're going to depreciate that asset based on the new valuation, the $30,000, and not its old historic cost. And finally then, the other thing we need to think about is that gains from revaluing an asset, now think about it, of course it's a gain. If you're increasing your assets, that's going to benefit the owners of the business, isn't it? It's a good thing. Anyway, gains from revaluations are not taken to the statement of comprehensive income. So this gain is not a profit, okay? You will only gain real profit or real income once you dispose of that asset. Okay, so remember we talked about disposals before. What we treat it as is a recognised gain. We're recognising the fact that our assets have increased in value and that's going to benefit the owners of the business. But it is not taken to the statement of comprehensive income. It actually forms part of the owner's capital or equity of the business. Because no gain actually exists. That gain will not materialise, will not be realised until such time that you dispose of that asset. But you have to recognise that a gain has occurred. So let's see how we calculate this gain or indeed loss when you revalue your assets. So you can see that little diagram there. Again, this is to help you calculate the gain or loss on revaluation. So you are going to need to learn that. So starting off then, we've got the valuation. That's going to be the revalued amount of the asset. So from my example, that would be the $30,000, what I want it to be, the valuation. I'm then going to compare that with the carrying value of the asset at the date of revaluation. So always be mindful of the date given to you on the date that you want to revalue the asset or the management want to revalue the asset. Carrying value cost minus accumulated depreciation. So assuming that that asset that originally cost us $3,000 had accumulated depreciation of, let's say, $1,000, then the carrying value would be $2,000. All right. Now the difference then will give you a revaluation gain or indeed loss or an impairment. That gain is what we're interested in, that positive figure that drops down the bottom. You've got a gain on the carrying value of that asset because its fair value or market value is a lot higher than its carrying value. Now, you've calculated the gain. You know how much gain is going to be recognised. Now what we need to do is record it in our journal. So here we go then, a journal adjustment for a revaluation upwards, so a revaluation gain. Think about what we're doing. We're going to increase the value of the asset up. So we are going to debit the asset cost account in the statement of financial position to increase that asset value upwards. Now if you've got an asset that cost 3,000 and you want it to be 30,000, well then what you need to do is debit it with the difference between what you've already got sat there and what you want it to be, so 27. What you then need to do at that point is to remove and decrease the accumulated depreciation account. Now the accumulated depreciation account needs to be cleared down. So then when you take the cost, the new cost, minus the accumulated depreciation, which would be nil, then the cost would be the new valuation that you want to incorporate into your financial statements. Okay? So then what we would say is debit asset cost with the 27,000, the difference between the original cost of 3,000 and what we want it to be of 30,000. Debit accumulated depreciation to clear it out, so that would be the other 1,000. And then your corresponding credit entry would go to the revaluation reserve. Now this is a new account. This is a capital or equity account. Okay, so we're going to increase owner's equity or capital with the revaluation reserve. It benefits the owners of the business. Okay, so you remember we talked about capital plus profit? Well, it'd be capital plus profit plus revaluation reserve. It benefits the owners, but it is not real income yet. It will only be real income once we've disposed of that asset. Now, if you're comparing the valuation of 30 to its carrying value of 2, then obviously the credit to the revaluation reserve would be 28, and the double entry would indeed work. So we must learn this new account of the revaluation reserve. It is a recognised gain. It benefits the owners of the business, but is not a realised gain. It's not an actual income item. It's not going to increase profits until such time as you dispose of the asset. So until that time comes, we've got to make the double entry work. It's going to the revaluation reserve as a recognised gain. So I think we'll leave it there in terms of accounting for revaluations. This is the theory behind it. In our next video, we'll have a look at putting some life into it by putting some numbers to it in an example. Okay, welcome back. What we're now going to do is finish off revaluations by putting it all together in an example, just so we can see how it works with the numbers. So we've got this example then, and this is Chris Lebowski. So Chris Lebowski purchased a building at a cost of $45,000 on the 1st of January 1994, with a useful life of 50 years. Chris's policy is to depreciate the buildings 2% per annum straight line basis, with a full year's charge in year of acquisition and none in the year of disposal. So we've got 2% per annum straight line, so that would be 2% on cost, with a full year's worth of depreciation and acquisition, so no proportionate depreciation in this example. Carrying on then, on the 1st of January 2009, the building has been valued by a qualified valuer. The valuation given was $150,000. So 1st of January 2009 is the date of the revaluation, bearing in mind that we purchased the building on the 1st of January 1994. So how many years later is this revaluation? Pause the recording whilst you're having a quick think about that and just running it through your mind. hopefully you should have all identified that this is 15 years later. Okay, so we're going to have the asset at cost, we're going to depreciate it 15 years, and then what we're going to do is the revaluation on the 1st of January 2009. Chris would like to incorporate this valuation in the financial statements for the year ended the 31st of December 2009. So we've got a revaluation at the start of 2009, but he wants to incorporate that valuation in the year-end accounts. Now a year would have passed since we revalued the asset, so we're going to have to depreciate the asset based on its valuation in 2009. Now it says that Chris has stated that the useful life of the asset will remain at 50 years. So think about it. After the revaluation, the life of the asset will still be 50 years. But we've already depreciated the asset for 15 years. So when we're spreading the valuation of the asset, it's already had 15 out of the 50 years depreciated. So that would mean then that there's only 35 years left at the date that we revalue the asset. Okay, so that is going to be useful when we calculate our subsequent depreciation on the revalued amount. So let's have a look at this requirement then. Part A, it says, calculate the revaluation gain or loss to be shown in Chris's financial statements for the year to the 31st of December 2009. So the first thing we need to do is find the revaluation gain. It clearly is. You can see that from the figures. Part B, complete the necessary journals and ledger accounts to record the valuation. Okay, so we need to do a journal and we need to do the ledger accounts. And we saw the journal entries in the last recording, so this will just be putting some numbers to that. And Part C, calculate the depreciation charge for the year ended the 31st of December 2009. So after the date of revaluation, how much depreciation would we charge per annum thereafter? So let's crack on with this then. And we're going to start off with Part A, which is calculating the revaluation gain or loss. So, the revaluation gain, Part A. Now, if you remember, I said there was a little pro forma to remember. We've got to compare the valuation of the asset, so the value that we want it to be. Now, if we look back at the question, they told us in the second sentence, in the third sentence, that the valuation was $150,000. So that's our valuation. That's the valuation we want to encompass in our accounts. We've then got to compare that to the carrying value of the asset at the date of revaluation. Okay, so we need to figure that out. So we're just going to do a little working there before we can then get to our revaluation gain or loss. So, our working then, the carrying value. Well, remember, that is the cost of the asset minus the accumulated depreciation. Now, the original cost of the asset was given to us at the top of the question. That was $45,000. And we said we're going to depreciate the buildings 2% per annum on a straight line basis with a full year's charge in the year of acquisition. Now, we know that if it's straight line, it's going to be 2% on cost. So that's going to be 45,000 times 2%. So that is going to give us $900 per annum as our depreciation charge. How many years depreciation have accumulated? Well, we've accumulated 15 years worth of depreciation up to the date that we revalue. So 900 per annum times 15 years is going to give us 13,500 accumulated depreciation up to the date of revaluation. So the carrying value at date of revaluation will be the difference between the cost and the accumulated depreciation, 31,500. So that's our book value or carrying value of the asset at the date we revalue, the 1st of January 09. So now we can build that in to our revaluation gain working. So 31,500 is a carrying value at the date of revaluation. If we compare that to the valuation itself, we should get a revaluation gain, because clearly it will be a positive figure, of 118,500, so 118,500. And that is the gain that we need to record in our journal and then ultimately into our ledger accounts as well. So now we've got that, we've answered part A. So now what we need to do is do part B and complete the necessary journals. So on a new page then, I'm going to start off with my journals. So my journal to record the revaluation gain. Well, I know that the value of this building has increased, okay, it's a gain, which means I'm going to have to debit and increase the building cost account as a result. Okay, so the non-current asset cost account, I want to increase that asset value up. Think about what's happening. The original cost of the asset is $45,000. That doesn't change, so year on year that account will be static. It will be $45,000 each year. So the balance already sat on that building cost account is $45,000. But I want it now to be, at the 1st of January 09, the revalued amount. And that was $150,000. So if I compare what I want it to be, $150,000, and what is already sat there as a debit balance, $45,000, what I'm going to have to do is increase the building's cost account up by $105,000. And that would be my debit entry. Okay, so I've already got a balance brought forward of 45. To get it to 150, I've got to increase it up by 105,000. Now, remember that at that point, at the 1st of January, I want it to reflect, or the asset value I want to reflect is 150,000. Now that isn't going to be the case if I have that accumulated depreciation still sat in my books. So what I do is I remove the accumulated depreciation by debiting buildings accumulated depreciation. Now if you look back, we calculated that, didn't we? We said that the accumulated depreciation up until the date of revaluation was $13,500. So what we're going to do is remove it, debit it out, get rid. 13,500. Notice then that the total of your two debits would equal 118,500, which we must equal to the credit entry, and this is where we're going to record that gain. We said the gain was $118,500. That is what we're going to credit the revaluation reserve with to increase our owner's capital or equity. So our revaluation reserve, 118,500, and our credit for the gain equals our debits to the asset cost account and the accumulated depreciation account. And you need to learn that journal entry for the exam. Okay, so that is very important. So that's some of Part B done. We've recorded and popped in the journals for that gain. Now what we need to do is record this gain in the ledger accounts. So for this, we're going to need 3 accounts. The buildings cost account, accumulated depreciation, and then the revaluation reserve. So again, I've drew out the T accounts, but again, feel free to pause the recording just to draw up some skeleton T accounts yourself. So we're going to start with buildings cost, which remember is an SFP account. It's a non-current asset. We're going to start with the opening balance brought forward, already sat there. And remember, it's an asset, so it would be sat on the debit side. So brought forward on the 1st of the 1st, 09, because that is the start of the year, 45,000. So that would be carried forward and brought forward from 1994 all the way through to this year, 2009. Now we said that we were going to debit our asset cost account to get it up to the valuation that we want it to be. So again, on that same date, the 1st of the 1st, 09, we're going to have a revaluation of an asset and increase it up by 105,000. So at the year end, at the end of December 2009, my closing balance will be 150,000 that I wanted it to be. And then that would be brought forward on the 1st of January 2010. It's an opening balance on the debit side because it is an asset, and assets are always debit balances. So you can tick off the first debit in the journal for the revaluation, and we've actually done that, popped in the opening balance and closed off that account. Now let's do accumulated depreciation. So, buildings, accumulated depreciation, again, an SFP account. We're going to start off with the opening balance on the 1st of January 09, so prior to the revaluation. Remember, it acts as reducing the asset value in the SFP, so that would be a credit balance. Which will be the 13,500 sat there. So we can proceed now to do the remaining debit, which was on the date of revaluation, a clear out of the accumulated depreciation account of 13,500. Now notice at that point that account is cleared, but I'm not going to close off that account just yet. This is at the start of the year, and we want the end of the year accounts. And we know that we will still need to depreciate the building even after we revalue. So we're going to leave that open because we're going to come back to that when we look at Part C. Now, moving on then, the final thing that we must look at for the time being is the revaluation surplus, or the revaluation reserve. Okay. Now, the revaluation reserve, again, is an SFP account. It is an equity or capital account, and therefore any opening balances would be on the credit side. Now, we don't have an opening balance because we've only revalued it this year. And that's the final entry, the credit entry. On the date of revaluation, again, that would be buildings that revaluation reserve relates to, cost and accumulated depreciation, 118,500. That's going to increase owner's equity, and that would benefit the owners of the business. So again, we're just going to close off that account now. So at the year end, the balance carried forward would be on the debit side. To open on the 1st of January 2010, the balance brought forward, opening on the credit side of 118,500. So there you have it. That is the double entry postings for the revaluation gain. Now, the final thing that we need to do is Part C, where they asked us to calculate the depreciation charge for 2009. This is all the entries at the start of the year, but time would have passed. We would have used that building. We still need to depreciate it. Now remember, if you've revalued an asset, any future depreciation is based on the revalued amount. So let's think about that computation then. So the depreciation. So we know that we're going to base future depreciation based on the new valuation of $150,000. And we're doing this straight line. Now, we know that of the 50-year life of the asset, we've already depreciated 15 years worth. Now, the life is remaining at 50 years. So at the date of revaluation, the remaining life of the asset is not 50 years because we've already had 15 years worth of use. The remaining life is only 35 years. So that's 50 years minus the 15 years that we've already depreciated. If you're spreading it over 50 years, then that's not going to be correct because maybe you've already depreciated 15 years, so you'd be double counting effectively. So future depreciation based on the valuation spread over the remaining useful life. 35 years. Don't be tempted with the 50. And it's all in the wording of the question. If they said the estimated useful life will be a further 50 years, well then yeah, you'd divide it over 50 years and spread the valuation over that. But it said it will remain at 50 years. Therefore, you've already depreciated 15 years worth. Anyway, so that's going to give you a depreciation charge per annum, straight line, same charge each year, for a rounding of $4,286. And the double entry would be as normal. Debit, depreciation, expense, you should all know this by now, and credit, your accumulated depreciation account, so your SFP account, 4286. And there you have it. All right, so the only thing we're going to do now is update the accumulated depreciation account with that 4,286. So at the 31st of December 09, our depreciation expense would be 4,286. Which means then when you're closing the account and balancing them off, this is the only account we haven't balanced, 17,786 is the total of the credit side, so the debit side has to equal, and then our balancing figure will be a balance carried forward. This is an SFP account of 4286. which will then bring forward at the start of January 2010, balance brought forward 4286. And that's our accounts closed, and that's the example complete. Now obviously I didn't do the debit to the depreciation expense, but you know how that works. I don't need to show you that again. You can go back to the depreciation recording if you wanted to see that again. But that's it, that's revaluations. Make sure you practice that at home. Make sure you remember how to calculate a revaluation gain and be able to do the journal entries as well. Thank you.